Hi. Welcome to another Argan Solutions podcast. I'm Fraser, and I'm with David Clark. You can speak, Dave. It's okay.
Give me a hint as to what we're going to be talking about and what people can listen to.
You're exposing the Argan Solutions podcast technique of no preparation.
Yeah, well,
um, so, about 2 weeks ago, I had the pleasure of being invited to show a film that I'd made in 2008. Remember those halcyon days?
yeah.
At the Totnes Cinema, which is like an independent cinema. Oh, it's just a great environment for watching films. So I made this film in 2008, so just after the financial crisis, and we were kind of in this space where everybody was kind of going, let's imagine a new financial system. Let's imagine what what the financial system or even the economic system could be, because actually at the time everything was so screwed. There was very much this feeling that we were in a position where we could rebuild, and we could create a new system. There was a lot of positivity, even in the context or the backdrop of all of the negative stuff that was going on in financial markets. I don't know whether Lehman Brothers had gone down at that point or not when I made it. Anyway, Schumacher College, which is just on our doorstep, invited a group of alternative economists
Right.
to come and speak. And they were going to sort of, I suppose, create at the end of the week that they were there a kind of manifesto of kind of new economics for the UK and for sort of the global system. So I decided to take a camera down there, and I borrowed the camera from my next door neighbors who are actual filmmakers. And then there was this very lovely guy that I met who used to be the ex commissioning editor of Channel 4 documentaries. And he said he'd interview people. So he went down, we interviewed all of these alternative economists. He interviewed them, I recorded it, and then I edited it.
Right.
It's like a 10-minute film, and put it on Vimeo, and you can find it under Holistic Economics, Eco-Nomics.
Okay.
So it was made in 2008. Anyway, we're all obviously talking about COP26 and climate, and how do we kind of reimagine how we should be, how the systems should be. And the main film was not mine. The main film was a film that was made in the 1990s. In fact, in 1990, by this guy, Nick Hart-Williams, which is why he kind of remembered the film that we made together.
Right.
And it essentially was because Robert Redford was a big environmentalist. Had been an environmentalist since the 1970s. And then in, I think, 1988, he'd heard Jim Hansen giving his testimony to Congress. So Jim Hansen of NASA, about climate change, about global warming, about the science that was essentially pointing towards increased CO2 levels and then towards the issues that gives rise to. So Robert Redford decided to bring all of the top scientists from around the world to his ranch at Sundance in Utah. And Nick Hart-Williams and a team of filmmakers interviewed all of the scientists, philosophers. There was the leader of the Iroquois tribe from New York State there. So there were a huge range of different people with different views. And they made this film, and it was called Profits and Loss. So profits, though, as PROPHETS, But what was really interesting is in 2008, I was really interested in what is it about our economic system that is really, could potentially be, at the core of the climate problem. So watching these films really brought those thoughts and the kind of discussions and the kind of process of like trying to unpick this system that we have and try to work out what's going on. And my central thesis when I was trying to interview people was really there's this thing called growth. And the question is, what is it about the economic system that creates this growth imperative? We kind of just assume, right? When we're talking, I studied economics and maths at university, right? And there was this kind of imperative, this kind of underlying assumption that we always grow. You have this factor, this growth factor. And, okay, you talk about deflationary periods and and recessions and things like this. But the long-term underlying assumption is that we keep growing. And we keep growing in a monetary sense. So as kind of GDP per head keeps growing. And you see that assumption also in the way that we think about our pension funds. So the people who manage our pension assets are also saying these funds have to grow
Yeah.
5% a year, whatever it is, so that Mrs. Miggins has a certain amount of money in her account when she retires at age 75 or 70 or whatever the number is. And to get there, she needs, we need compound growth of 5% a year. There was the Rio summit, and out of that came the kind of the concept of limits to growth,
Right.
which is we have a finite Earth and finite resources, and surely, therefore, we have limits to our capacity to grow. And actually not just limits to our capacity to grow, we have limits, we must impose limits
Yeah.
upon which we can grow, because otherwise we just consume ourselves. We consume the planet within, on which we live. And in a way, climate change is kind of the planet, the manifestation of the planetary response to that overgrowth and overconsumption.
I'm following what you're saying, and I've got a thought, which is that for lots of people who don't study economics and who aren't involved in finance and the finance markets, when they're talking about the economy and growth, the layman often, I think, comments and says something like, "Why do we keep on needing to grow?" And they say things like, we're on we don't have unlimited resources, so the economy, how can we keep on growing all the time? But strangely, when people express opinions or have expressed opinions like that in the past, it's almost like they're sort of belittled by the economists for not having an understanding of what the economy is about. It's like saying, why does a company need to grow all the time? Why can't it just stay, at a level? But people will say, oh, you just don't understand business, or you just don't understand the economy. But are you saying that things are changing a little bit now?
No, I don't think they are at the moment. I think
Right.
so. I think what you said there about the company having to grow. So there's a distinction here between listed companies and unlisted companies. So,
Right.
I work for an unlisted company, right? There is no pressure on my business to grow. We could turn over the same amount each year. We could make the same profit each year as a result,
Yeah.
or make no profit. We just make enough to pay the people within the business. There is pressure to grow because there is inflation in our economy, and that inflation is compound inflation as opposed to simple inflation. So this is where we need to make sure we understand the difference between compound growth and simple growth. So in the film that I made, there was an economist that talks about this, that sort of says, look, if you put 1 cent, 1 pence in a bank 2,000 years ago, and you inflated it at 5% a year,
Yeah.
but that 5% was simple interest, which means you only pay 5% on the 1 penny
Yeah.
in year one. You pay 5% on the penny in year two. It's
Yeah.
only on the original amount.
Yeah.
Okay. At the end of 2,000 years, that 1 penny plus all the interest would be £1 and 5 pence. It'd be so, pretty much nothing.
Yeah.
Now, if you applied compound interest to that same 1 penny 2,000 years ago, the effect or the impact of compound interest would mean that 1 penny would be worth about 300 billion balls of gold, each ball the size of the Earth in sort of 2008's value of gold. I mean, massive amounts. You can just do the maths on a calculator. I mean, probably actually break the calculator, and the number's so big.
Yeah.
Compound growth, compound anything, has a detrimental impact on the value of things.
Right.
Okay. And so what we have as a business is we've got potentially wage growth where people are saying, well, just a second, the economy, the price, we talk about inflation, we talk about 2% inflation, right? 3% inflation. In fact, at the moment, they're talking about 5% inflation.
Yeah.
Now, that means that, basically, if you had, 5% inflation for 10 years, let's say, that means prices increase by about 62%, I think. So if we just have 5% inflation or 5% growth of something, everything's doubling every 15 years.
Yeah.
So in terms of us as a business, if we just have one pressure, which is our wages, and let's say we're zero profit, so everything's on wages, then essentially every year we've got to increase our turnover by 5% to meet the wage growth. And actually we've got to double our turnover every 15 years to meet that wage growth. Now, what that means is that us as a business, okay, so if we were just stable or steady growth, we would just continue to kind of do what we were doing. But because we've got to double every 15 years or go up by 5% every year, we've got to consume more resources on an exponential curve, like a hockey curve, it was sort of,
Yeah. Yeah.
which is like the CO2 curve almost. And this is the problem. We have all these pressures on our economies, on our prices that are essentially follow compound growth curves, which means that we follow exponential growth curves. And so if you then go back to pension funds, right?
Yeah.
So it's another example. So I know that I get on my pension, I get a little thing from the pension manager who says, you've got X amount in your pension fund, and if it grew at 5% a year for the next, until you retire at age X, it would be worth Y.
Yeah.
And that is 5% on the 5% on the 5%, it's compound, right?
Sure.
So as participants in the global economy, I think there are 100, I forgot the number, but at COP they were talking about $130 trillion of kind of financial assets, right, out there, of which I'm not suggesting all of that's pension fund money, but a lot of it will be pensions. And unwittingly, we have the financial markets managing pension funds on behalf of ourselves, whether we're public, whether it's a company owned, whether it's a privately owned, whatever it might be. And the implicit requirement is that we need to get compound growth on it for the next 25, however many years until we retire. So if you take the case of, say, Unilever, where it had a CEO that was really trying to be very proactive about sustainability and about almost like this kind of, why do we have to grow kind of mentality. And he was sort of pushed out because the market didn't like the returns that viewpoint created for their end pension fund holders. So what we have is businesses at the moment that are under quarterly pressure to
Yeah.
keep growing.
Yeah.
And the only way you can grow your profits, because that's essentially what end investment managers want, you can either grow it by reducing costs or increasing income. So you can reduce costs by becoming more efficient, finding efficiencies. You can reduce costs by making people redundant, which people bring into that efficiency equation. You can reduce costs by, let's bring in a load of robots rather than people because they're a lot cheaper and they don't demand wage growth. And the other side is the income side. We need to dig more stuff out of the ground to sell more stuff.
Yeah.
And we've got to do this on this exponential curve. So the whole financial system is imploring these businesses, these listed businesses, more directly to grow, so that the end investors are satisfied. And that is what is going to break eventually. But again, I think we're going to move to another point where the pension industry is going to have another revelation, which is that it just cannot keep growing. We cannot keep demanding that the end assets that we invest in keep growing at compound rates to satisfy this need for us to live on £50,000 a year when we're 65 until we die. It just ain't going to happen. The end result, in my mind, is that actually we're going to have to move to a system where essentially pensions are looking after each other. Your pension is the community around you.
Yeah.
and the
Yeah.
people around you and the way that we take care of people around us. Native tribes don't have pension funds. When
Sure.
you grow old, you get fed, your community takes care of you, they feed you, you get a house, you do whatever you can, but they don't expect a payment per month from some outside source. And I think pensions are I think they emerged out of the 40s and Second
Yeah.
World War or around there, but it's kind of like a project that we've had over the last 60, 70, 80 years that just isn't fit for the end goals that we require. Going back to the films, it really reminded me that actually one of the actions as people, as individuals, and as families and as communities is we do need to kind of rethink the way that we use our money. By putting money into pension funds, we are indirectly or directly creating the monetary impact for growth in our societies, and maybe actually therefore we should be thinking about real assets that we invest in. So, is that a renewable energy project?
Yeah.
It doesn't keep growing; it just generates the same energy each year, or thereabouts. Or investing in some land to grow food, or investing, in something that is not growth related,
Sure.
but that is actually related to
Mhm.
providing us with almost like I'd say a physical based currency, an
Right.
asset backed currency. At the moment, if we think about our money, the pound that you have in your pocket or in your digital wallet these days is not backed by anything. If you went to
No.
the Bank of England and said, "Hello, I've got a £50 note. Can I have £50 worth of gold, please?" or whatever it is you've got in your vaults, they'd laugh in your face and tell you to go away.
Yeah.
There is nothing backing it. All that backs our currency at the moment is trust. And so trust can, as we all know, can disappear in an instant. And also with pension, what is the stock market if that's where most of our money is? The stock market is a big gambling pit. you know, if you go to sell your shares, you will only get back what somebody is willing to pay for them.
Yeah.
And that is based really on a trust in the underlying company and what it can do and what it can provide and what it will provide. And so it's very, very shaky foundations for having thousands, if not hundreds of thousands of pounds invested in that particular scenario. Whereas when you talk about asset-backed investments, so you put money into land or you put money into renewable energy project, community project or such, there's a real physical asset that you get out of that. You get kilowatt hours or you get food. There are people out there who are trying to sort of develop alternative currencies that are asset-backed alternative currencies. So that your one alternative currency unit is worth a kilowatt hour. You can get that in energy.
Yeah.
And especially after COP, I know they're talking about not investing in oil and gas, but investing in renewable businesses or investing in green businesses or whatever it might be. But that investment, you can bet your bottom dollar, will still require compound investment.
There's got to be a massive shift here. We sort of conjured this world of money, as you say, which isn't really backed by anything. You don't have to step very far back to sort of realise the illusion, if you like, that it's based on. But the other thing that struck me is that if you have like I don't know a large business that's very accessible to most people, like a supermarket. So a supermarket for its PR will be saying things like, we're doing this for the environment and we're reducing our plastic and we're changing the way that we source product to more environmentally friendly, less sort of carbon emitting methods and so on. So they give it that great story, and it's probably partially true. But fundamentally, everybody in that business is in some kind of weird sort of blinkered denial, because what you're saying is that in the boardroom, what they're really focusing on is that compound growth, which is a path to self-destruction. But nobody's got the gumption or the guts or the wherewithal to do anything about it. It's almost like they're on a plane that's going down, but they're absolutely happy to go with it rather than perhaps take control.
Yeah, that's it. I mean, basically, the boardroom won't be saying we must grow. Actually, what they're always saying is, Christ, our investors are putting
Yeah,
pressure on us. They need us to grow our profits by X amount. So they will have to sell more stuff. Or, what do we see in supermarkets at the moment? There's fewer people on the tills.
Yeah.
There's more like self-checkouts. It's reducing costs through lower, fewer people. But there is hope. So, I think I do believe that there was a group of pension fund managers that came out recently and said, actually, we have got to start reducing the pressure on the businesses that we invest in to grow. And I think, so there are movements that are starting to kind of appear, let's say, as people have understood what what is required and some of the issues, especially in this climate thing. And there's so much stuff going on in the finance world that's not necessarily public. And obviously we had a load of big announcements at COP26 about finance. And we need to sort of see how those kind of play out over the next 6 to 12 months. We do need to really think about where we put our money. We really do need to think about growth in the context of our businesses and the pressure, and also what that pressure then implies on kind of planetary resources that we may or may not be using as a result of that.
Fraser, do you want to just give us the details of that film again?
So my 10-minute film is called Holistic, and then Economics, but Eco-nomics.
Right.
So Holistic Economics. The other film, which is about 50 minutes long, it's called Profits and Loss. Prophets, the biblical profits and loss. Great. So look, I really hope I didn't bore you with more finance. It was a bit of a stream of consciousness this week, and really looking forward to our next podcast. And thanks for listening.
This is a How production. Please follow this podcast and share.